In this presentation, we will generate and analyze a balance sheet type report within QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We currently have the Open Windows open. You can open the Open Windows by selecting the View dropdown and the Open Windows list. We're now going to be opening a balance sheet report and be considering the balance sheet reports. Now remember, the balance sheet report is considered a report within QuickBooks, but for financial accounting, it will typically be considered as, in essence, the financial statements. The financial statements, the major financial reports, will be the balance sheet report and the profit and loss, or as QuickBooks calls it, the income statement, or as QuickBooks calls it, the profit and loss type of report. So whenever we go into those two reports, we're always going to be considering those reports as kind of our main reports, which you can also go into the trial balance as basically a combination of those reports without all the subtitles. Then when we think about all other reports, pretty much all other reports are basically supporting those major financial statement reports. So when you go into the reports, we are going to be considering the two major reports, balance sheet and the profit and loss report. You want to consider those the financial statements, however, those are the financial reports. All of the other reports are going to be basically generally supporting some component, some piece of the two major financial statement type reports, those being the balance sheet and profit and loss. All right, so to get to the balance sheet, we're going to go to the drop down up top into the reports. We're going to go to the company and financial, then we're going to go down to the balance sheet. Note that you can also find this by going into the report center, but I think this is the fastest way to do it. And so since these are the two main reports, you want to do it the fastest way and just get used to going into the drop down type format, reports, company and financial, and then the balance sheet standard. So within the balance sheet standard, there's a couple different ways that we can change the dates in it. And we'll go into more of these options in the future, but now just note that we only see one date here. Why do we only see one date here? Because the balance sheet is as of a point in time. Now, if we want to put a date range in, however, we can do so. So let's do this, for example, if I put a date as of 12/31/20, that's December 31st, 2020. Here is our report as of December 31st, 2020. Now, if I was to add a date range, which we will do now, it won't change this report because I'm going to have the ending date still be this time period. Let's do that now. We're going to go to the customized reports up top. We're going to change the date range, which we have now, a beginning and ending date, a from and a to. The from being 01/01/20, January 1st, 2020 to December 31st, 2020. If we then say OK, note there's no change to this report. So you might ask, well, why would there even be a date range? If you want to go into the detail in the report, that's when the date range has significance. So if I want to know about this checking account, I can go into another report by simply zooming into this field, by double clicking on it. That's going to be using the zoom feature and get to another report, the transaction by account, which is a timing report, not as of a point in time as is the balance sheet, and therefore has dates involved in it and needs that date range in order to run it. So we'll get more into this report in the future, but I'm going to close this back out. That's going to be the first thing we want to note, however, with the balance sheet. It's not a timing report. It's a report as of where we stand as of a point in time. Therefore, it only needs one date in order to see where we stand as of a point in time, as opposed to many other reports, including the other major financial statement report, the income statement, or as QuickBooks calls it, the profit and loss report. Now, the balance sheet is going to be, in essence, the accounting equation. This is our double entry accounting equation. This is the overarching basic report. It has basically everything in it. Every financial transaction is represented here in some way, shape, or form. So how do we see this? One way to do this is I would then hide some of all assets, right? So I'm going to hit this little triangle up top. There's all the assets, and then I'll hide all the liabilities and equity, selecting this triangle. There we have the assets equaling the liabilities and equity. That is the accounting equation. So assets equal liability and equity. That means that every financial transaction is included in this accounting equation in one way, shape, or form. Now we're going to go through this in a step-by-step process. Obviously, these two things are in balance. That's why it's going to be the balance sheet. We're going to open up each section of the assets, and we'll go through this balance sheet from top to bottom, starting with the assets. So if we open up then the assets, going to open this up with the triangle. I'm going to hide all things except for the top section, and we'll go through this in a section by section format. So first, we're going to start off with the current assets. Current assets are going to be more of the liquid type of assets, more liquid assets, more things that are closer to cash. So they're going to be consumed fairly soon in the future. And then we have within current assets the subcategories of the checking and saving. So this is actually going to be, in essence, our cash accounts, which includes the checking account. Note that if we have multiple checking accounts, then we can basically collapse them into this kind of subcategory that QuickBooks makes by default by creating a whole nother kind of type of account, which is the checking and saving. So we could have multiple checking accounts in here depending on the type of company that we have. We then have the accounts receivable, which once again QuickBooks creates as another kind of subcategory. So within accounts receivable, we have the accounts receivable account. Most companies will only have one accounts receivable type account, but any account that you set up as a receivable type of account will then fall under this subcategory. So note that QuickBooks is basically breaking out the subcategories by type. And the types, as we've seen in the past and as we'll see in the future when we create them, are a list. So the lists drop down over here. If we then go to the if we then go to the chart of accounts, we have the types over here, right? So this is a bank type, the accounts receivable, other, fixed assets. These are the types of accounts we're setting up as we create accounts within the chart of accounts. So if I then go back to our balance sheet, then the next type is other current assets. If we select the drop down, we have other types of things that would fall into the current assets, including inventory, prepaid insurance, undeposited funds. And then the next type is going to be the fixed asset type of accounts. You might hear this called property, plant, and equipment in other type of software or accounting areas. So you want to just know the terminology. Obviously, the cash account up here, if someone else was talking about it, they'd call it cash accounts. QuickBooks calls it checking and savings accounts. So just note the terminology. This could also be called down here the depreciable assets, property, plant, and equipment, PP&E, property, plant, and equipment. So if I was to select that triangle, then we have the furniture and equipment, and we have the accumulated depreciation for it. Now, we could set up other categories in there, such as a building might go in there, land might go in there, and they would all be categorized into the subcategory under the fixed assets. Also note that we have the cost of them. So when we think of a property, plant, and equipment or a fixed asset type of account, it will include the cost item or an accumulated depreciation type of account, which is basically the contra assets type. So what we're saying here is that this is what we bought the assets for. This is how much they've gone down in value, or how much of the cost we have allocated out. That's going to be the accumulated depreciation. The difference between the two then, in this case the 102,225, is the book value. Also note that the accumulated depreciation isn't normally listed before the asset that's related to it. It's usually the other way around. Why is QuickBooks listing it this way? Because QuickBooks is basically saying this is the account type of a fixed asset type of account. And within the account types, because there's no account numbers, we're just listing them in alphabetical order. Therefore, accumulated depreciation is before the furniture and fixture, which is kind of funny. Shouldn't really be that way. You could fix it with account numbers. However, the account numbers can be a problem if you're not used to them. We may go into account numbers more in a future presentation, but we will not be using account numbers in this problem. Okay, so now we're going to go to the liabilities and equity, which is the second half. So let's first, I'm going to triangle up the assets here, and then let's go to the second half, which is going to be the liabilities and equity. Remember that the assets represent what the company has at a certain point in time. The liability and equity then is just basically who has claim to those assets. Who has claim, who owns, in essence, those assets. Do third-party vendors or third-party people have a claim to them because we owe third-party people? And whoever the third-party people that we don't owe money to is us, the owners of the company, and that's going to be equity. So who has claim to the assets? We owe some of them to third-party folks, liabilities. The rest of it is claimed or owned, in essence, by the owner, equity. So then if we select the drop-down then here, I'm going to close everything up except for the top triangle. We'll go down through this one thing at a time once again. So I'm going to collapse all of these and we'll go through these one at a time, starting with the liabilities. So we got the liabilities and equity. So of these two, notice again, assets here, of that 228.89, we owe basically 78,856.64 of it to someone other than the owner, liabilities outside the company, and the rest of it is owed in essence to the owners, owned by the owner. That's in equity. So if we go to the liabilities, then I'm going to open up the liabilities. We have current liabilities, long-term liabilities. Current liabilities are going to be those that are going to be due within a year's time period. So they're going to be, that's kind of an arbitrary cutoff date. They're due within a year. Current liabilities, if we open them up, include, in this case, accounts payable, the credit card. Now, accounts payable, once again, just like accounts receivable, if I select the drop down, we get the account. Now, there's usually only one accounts payable account in a company, but any account that's set up as an accounts payable type of account would be set up here, would go into here. QuickBooks is making a drop down, a subcategory for every type of category that is set up. And we have to have the accounts payable as a different type of category because we need the special kind of fields to track the vendors that will be connected to them in a similar way as with the accounts receivable, us having to track the customers. Then we have the credit cards. So credit cards is a special type of field, and therefore we have the credit card type with the different credit cards that could be listed then within it. Then we have the other current liabilities. This would be everything else that doesn't fall into kind of a special category for current liabilities. In our case, the loan payable, the current portion of it, the payroll liability, sales taxes. Next, we have the long-term liabilities, and that's going to be anything that's going to be due over a year, outside of a year's time period. And so that's going to be the loan payable in our case. Then we're going to go down into the equity. Within the equity section, we're going to have the owner's equity. So we have the draws and the equity and then the net income. Now, this is a little bit different than you might see in other type of areas. And there's a couple differences that could be involved depending on the type of entity we are in. So equity is often the most confusing section to many people. If you think about equity as a total, it shouldn't be that confusing once you wrap your mind around the fact that this total amount represents basically how much of the assets are allocated or owned directly or not owed to a liability. That's the net assets of the organization. Then we have to think about, well, what is that going to be called? What is this equity account going to be called? Well, in total, it could be called different things. If it's a sole proprietor, as we have set up in this setup, then they call it a capital account. That's what many people within financial accounting would call it, the capital account, the owner's capital account. Notice QuickBooks calls it the owner's equity. So the QuickBooks term for it will be owner's equity. If we had a partnership, then we'd have different, what would typically be called capital accounts for most people, that would be owed. And that would mean we'd have to be breaking out then the value here that is allocated to the owners, to those owners that is allocated to, with different capital accounts. If it was a corporation, then we would call them shareholders, and we would call it stockholders' equity. And you would think, well, what if there's a ton of stockholders? We'd have it'd be like a partnership with 1 million stockholders. Well, we don't have to break it out like that because the stocks are all standardized. So the stockholders' equity is actually a little bit easier because we could just say, hey, it's all what is owed to the owner. And in essence, you could think of it as basically every owner owns, or every stock owns, the same portion of the organization. They're all the same. And that standardization in stocks would allow us to distribute it out. So here we have the sole proprietorship, and we're going to call in total its owner's equity. Now, the other thing that's a little bit funny within QuickBooks is they have this account down here, or this amount, that's going to be for net income. And what QuickBooks is trying to do is trying to say, hey, look, this is how the balance sheet is tied to the income statement. Because you'll recall that we said that all accounts are in the balance sheet. All accounts are represented here. So you might think, well, why is the income statement, even a substantial statement if everything is in the balance sheet? And it's kind of true that even the income statement is a supporting document, in some ways, a supporting form, a supporting report, a supporting financial statement, the profit and loss to the balance sheet, because really everything is on the income statement is included in the equity section, because the equity section, it all rolls out into equity. The income statement has given us more detail about the total or sum number in the equity section. It's giving us the timing in a detailed format that is in the equity section here. So QuickBooks is trying to kind of point us in that direction. They're saying, hey, this net income is what you earned in the current time period. Now, QuickBooks will usually say, well, what is the current time period? Because it says a point in time up here. So notice, even if I just put 12/31 and I didn't put a date range in the date range, QuickBooks will typically calculate this number down below based on the current year that we are in. So it'll take the January through December of 2020 in this case, the whole year. So you just keep that in mind if you want to compare it to the income statement. And then it'll roll into, if I go to the next day up, for example, I'm going to go to the next year, 2021, just hitting the plus button and then clicking down here to refresh. You'll note that if I scroll down, it rolls out of net income, disappears, and then it rolled into the equity section, which is what you would normally think it would be. You don't normally see net income in the balance sheet. So I'm going to go back a day and then go back in, and there's that net income back there again. So that's kind of a quirky thing within QuickBooks, but you can see why they do it. It kind of ties out the balance sheet to the income statement. And then you have the draws account up top. Now the draws represents the amount that the owner has taken out of the business. Note what we're hoping to happen is we have net income. In this case, it's a loss, but hopefully we're going to have net income over time that then rolls into the equity section. And then the owner then takes money out of equity, reducing equity and reducing cash whenever they need it. And then we're going to track how much money is taken out of equity through the draws. So the draws is naturally a negative kind of number. It's kind of a contra equity number. It's going to be reducing the equity as the owner takes the money out of the company. Okay, so that's going to be that. Now let's take a look just briefly at the profit and loss just to see how this balance sheet ties into it. We should see that 1,063 in the profit and loss. If we go to the reports up top, we go to the company and financial, we want to take a look at the profit and loss standard. Within the profit and loss standard, we have to change the dates for the entire year, 01/01/20 to 12/31/20. And then we have the income and expenses. Scrolling down, we have the bottom line number, the 1,063.08 at a loss. And that, of course, is the number that is on, if we go back to the balance sheet in the open windows, on the balance sheet here. So it's showing how those two financial statements will tie together.